Well, thank you very much to the organizers for inviting me to discuss this paper. This is really a very, very interesting paper. Easy to read. Unfortunately, I don't have much to say about the paper because I basically agree with it. I'm sure Claudio Borio in the next session will have a lot more to say on this. So I basically agree with the main conclusion of the paper. The main conclusion is monetary policy shouldn't be used for financial stability purposes. So the basic question, again, is the relation between monetary policy and financial stability policy. And the answer that Lars gives to this question is that they are different policies with different goals, different suitable instruments in many countries with different responsible authorities. There's, of course, interaction between the policies, and then he mentions this, the interaction, as an example, the interaction between monetary policy and fiscal policy. Of course, monetary policy has an effect on, let's say, government and revenues and expenditures. On the other hand, fiscal policy has an effect on inflation and interest rate, but they are run separately, taking the other policy as given. So, at the end, Lars' conclusion is that monetary policy should not be used for financial stability purposes. Let me give an overview of the paper, at least how do I see it. In the second section after the introduction, Lars talks about how different policies are distinguished, and basically he talks about goals, instruments, and authorities responsible for the different policies. Then he goes on and talks about monetary policy and financial stability policies and how should they be distinguished. The goals are different. Of course, the goal of monetary policy is price stability and real stability. The goal of financial stability policy is financial stability in a broad sense. He likes this definition of financial resilience. The instruments are different. The instruments of monetary policy are policy rate and policy communication. In some special cases, also the purchase of assets, QE policy. The instruments of financial stability policy is, the instruments are different. Basically, financial supervision and regulation, more specifically, capital requirements, liquidity requirements, and more specifically, loan-to-values, provisions, et cetera, et cetera. He talks about financial stability from a broad perspective. In a way, he doesn't make the distinction between micro and macroprudential policies, although he understands, he mentions the difference, although the line, it's a line quite difficult to draw. Then section 4, should monetary policy have a third goal, financial stability? And the answer is no. Then he makes the difference between monetary policy and central banks. Central banks can have financial stability as one of the mandates, but the important thing is that they have different bodies in charge of each goal. And why monetary policy shouldn't have a third goal, this is financial stability, basically because monetary policy cannot achieve financial stability. He mentions the global financial crisis and its aftermath as good examples of why this doesn't apply. Price stability does not imply financial stability, and leaning against the wind is not recommended. Then he has this important result, he mentioned that in his presentation, that when financial stability policy is weak, the margin of cost of leaning against the wind of benefits are likely to be even larger. Should both policies be conducted separately or coordinated? The answer for him is separately. Here he makes the distinction between crisis prevention versus crisis management. Basically, my comments are going to be related more to crisis prevention rather than crisis management. In crisis management, of course, they have to coordinate and coordinate quite strongly. Should monetary policy and financial stability policy be conducted by the same authority or by different authorities? The point that Lars makes is that they should be conducted by different decision-making bodies. In that sense, he mentions the example of the Bank of England, which is one authority but with two separate decision-making bodies, and the Risk Bank, in which has two different, completely different institutions. I'm not sure whether, I mean, this is my interpretation, but I've got the impression Lars can tell us more that he would rather prefer that they are in different institutions, completely separated. What if monetary policy would pose a threat to financial stability? That happens in very rare occasions, according to Lars. But if that is the case, there have to be very clear responsibilities. And then he mentions the example of the Bank of England, and where the Financial Stability Committee has to tell the Monetary Policy Committee that there is a risk that monetary policy is imposing a risk to financial stability, and then the Monetary Policy Committee has to make its own decision. Then he goes on with a Studios experience and with all the cost-benefit analysis of leaning against the wind. And basically, although he's very careful to tell us that somebody can find benefits bigger than cost, he's found that costs are much larger than benefits, and hence this is not a recommended policy. The final conclusion I would say is not ask too much from monetary policy. So what are my comments? My first comment is that I agree with Lars' policy prescription. I see this as a policy paper, although of course it's based on the background material that he presented here. It's not in the paper, but it's in his GME paper. So I agree with the basic policy prescription. Monetary policy doesn't have the instruments to deal with financial stability policy. So I'll talk basically about the Chilean experience. One episode in the Chilean experience, and also we'll mention some caveats or some subtleties that I think are important to have in mind. In a way, I think this is sort of a black and white paper, in the sense that that is either this position or the other position. I think that there are many grays in this discussion, which I would like to mention, basically regarding the institutional framework. So, how do we see this in this country as two different policies? So in that sense, in terms of the policy decisions and policy framework, in the case of Chile, these are completely different policies, and they have different instruments. The institutional framework, though, is somewhat different from what I see as the optimal institutional framework that Lars presents in his paper. Why is that? Because the central bank has a mandate in terms of financial stability. I will talk a bit more on that later on. Banking supervision, financial supervision, is not within the central bank, but it does have, at least you can think of having some mandate regarding financial stability. And that's the reason why it is part of its policies. We do have a Financial Stability Committee. It's chaired by the Minister of Finance. And in that committee also participate the Banking Supervisory Agency, the Pension Supervisory Agency, the Securities and Insurance Supervisory Agency, and the Central Bank. Let me mention this example. We did have, during the last several years, a significant increase in housing prices. These are in real terms. This is something like 10% real per year since 2010. Before that, we had a period of very stable house prices. But then they started to increase and increase in very significant rates. The first thing that the central bank did at that time was just to make the information, to publish the information. Actually, the information was publicly available, but it's different that the central bank mentions that in its financial stability report. And we did that. I was at the bank at that time. The second thing was to sort of warn against this trend. Not warn in the sense that this is a bad trend or a good trend or whatever. It basically was saying, this is a trend, this is happening now, it didn't happen in the previous period, and it is important that all agents involved in this market, let's say construction companies, real estate, banks, other financial institutions, consumers, be aware that here we have a change in trend. The trend continued, and at the end, what the bank did was to go to the Financial Stability Council, present the situation, and finally, the Financial Stability, one of the members of the Financial Stability Council, which is in charge of the policies related to this particular issue, which is the Banking Supervisory Authority, decided to implement measures regarding this particular issue. And those were basically a system in which you link provisions to loan-to-values. The Financial Stability Council works as in Sweden. It's a consultative body. It's not a decision-making body. The decision-making is in the domain of the different agencies participating in that council. So we did have this episode. But the important thing here is this: monetary policy was never thought as a possible instrument. We had, during that period, two sub-periods. In the first sub-period, the economy was growing at high rates. In the second one, the economy was decelerating. I don't remember of ever talking of using monetary policy or interest rate as an instrument to have some effect on this trend of housing prices. And the reason, basically, is the reason that Lars gives in his paper. If we had done something, it would have to be, we should have increased probably the policy rate by 300 basis points, 400 basis points, to have some effect on this, which of course would have killed the economy. Actually, in the second part, on the second sub-period here, we actually cut rates. So finally, the financial stability instruments were used to deal with this issue. Let me finish with some issues. The institutional framework. We do have a different institutional framework from what Lars recommends in his paper, in the sense that the central bank has a mandate on financial stability. Of course, here history matters. We didn't have a financial crisis in this country, as in many other emerging market economies. The financial system was very resilient, very solid. So we didn't see much argument for changing the institutional framework. Of course, we learned from the financial crisis, and we've implemented, well, this Financial Stability Council. We are in the process of implementing. We have implemented some parts of Basel III. We're in the process of implementing some other parts of Basel III, et cetera, et cetera. However, the institutional framework is different. Financial stability, when you read the act of the Central Bank of Chile, it's interesting because it has two mandates. One is price stability. The second is payments, the well-functioning of a payment system. So you can say, well, then financial stability, it's not in the mandate. But then you go on and read the chart, and it's a chapter which is titled Financial Stability. Talks mainly about lender of last resort, which would be crisis management rather than crisis prevention. But then it has a lot of instruments, gives the central bank a lot of instruments related to crisis prevention. In the paper, you say that the central bank, as you know, according to your knowledge, the central bank doesn't have crisis prevention instruments. I wouldn't say that that's the case. Actually, reserve requirements, liquidity requirements, capital flow management policies, exchange rate policy, maturity mismatches, counter-cyclical capital buffer, and put that in asterisks because that's something being discussed in Congress at this point with a new banking law. But basically, there's no doubt that that specific instrument will go to the central bank. So it's kind of difficult to argue that the central bank doesn't have a mandate, at least in this case, on financial stability if it has all these instruments and if actually the act of the bank talks about financial stability. The Central Bank of Chile also publishes a financial stability report. Of course, if you publish a financial stability report, you're not necessarily, let's say it this way, if you talk about fiscal policy, you're not necessarily responsible for fiscal policy. But if you publish a financial stability report and you have in your act sort of a mandate on financial stability, you end up having a responsibility on financial stability. And actually there's been some cases with some small institution going under in which the central bank has been asked to go to Congress to explain what happened. So I would say that at least in our situation, it would be very difficult to argue that we don't have at least something to say regarding financial stability. I have one question for Lars. In the case of Sweden, the central bank participated in the Financial Stability Council. However, it's not in its mandate. It doesn't have any instrument, according to his paper, regarding financial stability. So why does the Risk Bank participate in the Financial Stability Council? You can think of at least two reasons. One is crisis management, in which, of course, it has a role of, it has a role as a lender of last resort. I've heard some people saying, well, the central bank has very good professionals, know about these issues, but you know that there are other institutions that can have the same kind of, let's say, analysis. But if you want to completely separate both policies, does it make any sense for the central bank to participate in the Financial Stability Council? Again, I think that there are some arguments for it, but I'd like to hear from Lars his views. Finally, this distinction between macro and microprudential, I understand that they're not that relevant in some institutional frameworks, but at least in the case of countries such as Chile, where the central bank has a mandate on financial stability, it's quite important to try to differentiate them. I perfectly understand that it is difficult to draw the line, but as the central bank is going to be in charge of macroprudential, you need to define what macroprudential is. Thank you.